Holy F. Are stocks about to crash? Because the AI bubble has a lot of people worried, and the S&P could decline by as much as 28% according to this pattern. That's right. It would basically mean that we crash land back here on the 50 MA or the short-term price. That would be exactly a decline of 28%. This weekend, I talk about how we could get 5 in a row, question mark. Well, that's pretty much this pattern right here. We have 4 weeks of selling in a row. It's not only that, there is even more bearishness in mind. If we look here to Bitcoin on the left and the S&P on the right, Bitcoin's been a great leading indicator. We can see a huge M or more downside forming here on the left-hand side. And for the S&P, we're only about to lose the 50 MA. The pattern gets worse as we inspect a little bit closer. Here on the left-hand side are Bitcoin. We note that, and pause if you need to, the notes are right here. We see a head and shoulders forming. We lose the 50 MA, and the neckline is almost exactly on there. We even see a kiss of death or a rejection right here. Isn't that kind of exactly what the S&P kind of did? It is. So that would mean we could decline by as much as down to 620 or 591 to complete that same M that we looked at in the previous pattern. Gets worse though. If we look here to the weekly chart with Bitcoin on the left and the S&P on the right, here is where it gets really curious. We have a golden cross, we have our double top, we have a golden cross, we have our double top. Then we slam down to form the first decline, which basically tests the previous all-time high. Then we form a higher low. Well, if that continues, like we're looking for a decline to as low as roughly 500, giving more support to that number I just talked about, that 495 or that 28% decline. If we go even further, though, this is where it gets worse. So here on the monthly charts, remember, we're going through the one-day chart, comparing it to Bitcoin. We're going through the 1 week chart, comparing it to the Bitcoin as well, and then going to the 1 month chart, comparing the S&P to S&P. This is where it says that it implies we could get more downside. Very simply put, we now printed a weekly lower low. We're going to have some level of bearishness into Friday or monthly candle close. So what's going to happen here? Are we going to save it or are we not? Are we going to close below 652.84 because the market is moving very quickly right now? These are called failed breakout patterns. So happen right here, happen right here, happen right here. Those led to 20+% declines every single time. Here's the chart that really has my attention though. This is the quarterly chart, and it actually has some caveats here where we could potentially have a save. Why? Because of history. Going back to 1998 to 1999 and 2000, we note there's a very curious pattern here. These candles take 3 months to form though, so they happen very, very slowly. I'm going to come back and talk about these in a moment because honestly, it just takes more time to go through, but pause right now if you need to. The notes are all right here. I'm talking about a engulfing candle, which is what we talked about a lot recently. But if you go to my notes, which I share very frequently, and they're 100% free, go to the second link in the description. It should say free notes. If you're wondering where this number right here comes from, 613.23 or a quarterly backtest, that's from exactly right here. So I will walk you through that a little bit later in the show. It just takes a bit of time to explain it. I've already shown you exactly what I think because I gave you the notes. Let me jump back to my notes here. Where are we? Where are we going here? Right here. So when I say fully bully boomtown buy all dips above 610, there's a specific reason for that. 613 is above 610. However, 610 is very important. And if all we do is look at the annual chart, because what we often talk about is, are we above or below the previous candle high? Well, as long as the S&P is above 610, I shot this in December 23rd of 2024, it's bullish, it's good. So if we come down to as low as 609.08, it's still technically bullish. It's a back test of the previous high. So going back to the notes now, that is where the 613 number comes from. It also just so happens that we should be looking for it either this quarter or into next quarter. So red on the daily, 4 out of 4, or 100% bearish, 4 out of 4 on the weekly, but we're still technically 4 out of 4 on the month. The higher low isn't holding though, so we are going to lose that. And then we look to the annual chart or the 2025 number, remembering that trading stocks should not be hard. We want a bearish cake. Well, let's follow the bearish recipe. Print a lower low, close below, then do it again. That's it. After that, lower highs are sufficient because the trend has changed. So when I go right here to my notes and I say that lower highs are sufficient, that means that the onus is now on the bulls to fix the chart. It's not all that complicated. Shifting forward here to our weekly levels. Here you go. Pause right now if you need to. Same thing here. Here are the key dates that could drive the chart and the key levels that could drive the chart. Moving forward here to our weekly pattern, this is where we have mixed signals on the 1 day and the 1 week versus the 1 month. The bears do have the edge, though. They have momentum on the 1 day and 1 week. We've breached the monthly higher low, which means we're going to be closing with at least 1 out of 4 bear, potentially 2. And then, when in doubt, be patient. Remember, there's notes above that I reviewed, and we're closing at or near the low of the candle with volume. That implies more downside. Review the other patterns above, like I just mentioned. So if now we shift gears here to asking ourselves, why did we stall out around roughly 690? There's more than one reason why. 690 is a Fibonacci extension. It's a mathematical number. So algorithms like MyAlgo, the algo.com, we look for exactly this. This is the receipts going back to January 5th of 2025. Here's what I said. Here's my 2025 template. 690 is the target on December 25th of 2025. If this does not break, remember, a failed breakout, or what I just showed you here on the monthly chart, is exactly what I was worried about at the beginning of the year. I'm a scaredy pants. So it's not a good omen, but we will not ignore the trend. So it's bullish until we do this. We did print a lower low. You can see it right there. But then we snapped back and rallied by 100 points. So this is basically the same thing as what I said the year before. Follow the trend. The trend is your friend. What's our target? It's the 161. And after getting through the 161, we got to the 261. So remember, traders do more than one thing. What do? They take profit. If levels hit like 690, look at our high here. It's 689.7. It's within a whisker of getting to that area. So what do? Man, they're selling first, asking questions later. Targets hit, trim, take profit. Some people will exit, myself included, if more key levels break. People want to chase performance, let them. It's not going to be me. I'm going to ask you for a huge favor, one time and one time only. Could you please consider smashing that thumbs up or subscribing to the channel? Thank you very much ahead of time. All right. Oops. No, I don't want to leave the studio. I want to leave this page. All right, there we go. Still recording. So ask yourself, what are people doing? What are they doing on NVIDIA? What are they doing on Palantir? Are they exiting or are they taking profit? Hard to tell sometimes, right? Well, blowout earnings. Oh my God, never seen anyone do an earnings report like this. What happened? Down. What happened to NVIDIA? Same thing. Blowout quarter. Sell it. The higher the gap up, the more you want to sell. At least it gapped up. Palantir could not even do that. Everyone has a reason for the reason why stocks are going lower. To be honest, it doesn't matter. Technicals what drive my decision making. If I look here to the key things that could drive this week, there's not a whole bunch on the earnings deck. There's a couple of companies, but who cares? Here's what matters. We close early on Friday, and we're also not open on Thursday. So this week is going to be particularly important because the previous notes, which I'll show you again one more time, and we'll come back to round the story out by looking at these exact notes. It's the quarterly candle. I'll go through these in more detail. But please remember, Friday really matters for the weekly, for the monthly, and for where we could go from here. So Thursday, we're closed. On Friday, it is a shortened day. So what happens into the first half of the week is going to be very, very important. Looking at the data that is available, this actually suggests we're due for a bounce. It's a descending triangle or a falling wedge. These are usually bullish patterns, but we have to get out of this extreme fear. We have to go from extreme fear, back up into neutral, back up into greed. It's going to be looking in the rear view mirror. Here's a CFTC net short positioning. So we had a big gap in data. And as of right now, jumping from September to November, they're just as short as they were before. So these bears are not relenting. And this is potentially motivation to keep driving the chart lower, or it's going to be fuel to drive the charts up because they're less bearish than they were before. So now we got low, higher low, back to net long. Oh, low, higher low, back to net long. Are they going to go net long? Low, higher low, net long. Low, higher low. Are they going to go net long? And then also, there's a 71.0% chance we're going to get a cut in December from the FOMC, or the Federal Open Market Committee, which basically means Jerome Powell. 71% chance. That's a lot better than where we were at the beginning of the week. It was actually 55% chance we're not going to get a cut. Here's GDP2. Oh my goodness, this is incredibly strong. 4.22%. Congratulations, President Trump. That is a rock star number. Looking forward to the key things that could drive this week. Remember, Thursday we're closed. Friday is an early day, which means we're pulling forward core PCE to be on Wednesday. This is going to come out after the market's open. Normally it comes out at 8:30. On Wednesday, it's coming out at 10. Look at the numbers. If they come in as expected, I think the market might find some relief on this. And what's the reason why? Hey, it's not as bad as what we thought it would be. It's just the same number as before. We're going back here to September, where we said that we're flying blind and we don't know what's going to happen. This is the last data point the Fed is going to see. They're already worried about employment. And this number here is not a good one either. So we see that PPI is rising, but I'm going to leave that for later. This is the reason why we could sell off more into the beginning of the week. Remembering, the note I just showed you says that by closing at or near the low of the candle, the downside is implied. So if this pattern's going to fulfill, we're going to go lower into the first half of next week, and then to be determined. It really depends on what the data says and what technicals drive the charts. Okay, so we talked about the key levels. I've already given you the key dates, and I've already given you the key levels. Pause if you need to, or rewind to get those. So in terms of taking profit, I'm not a perfect trader. I've made every mistake in the book at least once, probably twice, but here's what I'm going to do. So taking profit, as we alluded to before, exactly. I got some weak stocks, right? Some of my stocks are just not performing as well. So I've had to adjust my levels from the previous week because they got blown out. My account was at 19.7 last week. Yeah, I took a shot on it too. I'm down here to 18.6. Still very happy with that. But even though some stocks are fully funded, I got to let some of them go. If they don't perform this week, I'm firing them on Monday. So here's what it says. I have some weak stocks, which include, weak stocks that are likely to be exited next Monday, basically in a week, if we don't snap back on Friday. So I'm not going to do anything like I have for the last few weeks. I prefer to coast and respect my plan. I prefer to coast and respect my plan. What does that mean? Not bad. I'm just going to wait. I prefer to coast. I prefer to coast. That's what I've been saying for a while, right? I'm not doing very much. Not likely to make any major moves. I'm just waiting. It's called patience. Sometimes that's hard. And not everyone can do it. It's actually quite difficult. So here's 1, 2, 3, 4, 5, 6 stocks, which are likely going to get fired. Some are performing poorly, like Under Armour and Trox, which are not giving me any profit. They're just deleting money from my account. Some other ones here like DDD, like Tilray, and what's the other ones I said here? AREC, TE, Tilray. These ones have done really well. Like on TE, I'm still up by 75%, and I've paid for the trade twice. It's funded twice. I'm still going to let it go, though, because I don't want to be caught offside. My goal going into the end of the year is just a coast. I just want to protect this account. I just want to protect that number. It's so good compared to the market, which is up by 12%. I went to as high as roughly 20, and the market went up to roughly, I think it was 16, 17%. Now it's down here to roughly 12. So my goal is just to protect the account. That's it. And this is where, as we get more progressively bearish from the 1 day to the 1 week to the 1 month, I can't ignore the levels. I don't trust my gut. I trust my levels. Here we go. So now I'm going to give you a little bit of a preview in terms of something we're going to launch going into next week, which you can get value from if you want to join me after we relaunch. On the 1 day, it's a sell. So to make it really simple, this means that the 1 day chart is currently oversold. You might have noticed that. Chart looks a little bit oversold. It is. So as of right now, we are now below the short-term price. And what this basically means is that we're in a short-term corrective wave. We've had 4 weeks of selling, potentially a fifth. What is going to happen with my system is that this means we're due for an alert. We went from buy the dip, which is green, to sell the rip. Sell the rip means we're going down on the 1 day chart. However, if we look at the 1 week, so we see 1 day is bearish or sell the rip, but the 1 week is actually still bullish. So what I'll be watching for is to see whether or not these candles can hold. We have roughly 0.5% more weeks of selling until we come down and lose that area. On the 1 month, it's pretty much the same story. I can show you right here with the summary. So on the 1 day, it's going to take 1.23 candles to recover. On the 1 week, we have roughly 0.42 candles in support, which means that we're still actually trending up. Over here, it's 1.5 months. So we would still have to sell off for roughly 1.4 to 1.5 more months before there's anything we need to look at. So the 1 month chart that I showed you before says that, man, we're oversold. Sorry, we're not oversold here yet. It's just one lower low. So the same warning that we got on the 1 week, I'll show you again. It's getting up to roughly 2.5. That means we're pretty stretched. We're far from the moving average. We've talked about that before. Looking here to the 1 week chart, what happens when we push too far from the blue line, which is our home base? Well, we come back down to it. Push too far, come back down to it. Push too far, come back down to it. Happens on all time frames too. The 1 day, the 1 week, the 1 month. That's exactly what I'm pointing to here. I just want us to come back down to the short-term price, the average price over the previous 50 months, or basically the last 4 years. So that's all I'm looking for. When we look at the charts, I often say we have to wait for the chart to resolve. So going back to the notes one more time, if we go back to here, I'll show you exactly what I'm watching for. I just want to see what the charts resolve with. Either the daily is going to get fixed first, which means we go back to kind of bullish. We print the higher high. The weekly could potentially do that. But otherwise, the weekly is going to break the monthly. And that could lead to the decline down to roughly 613. All right, so that's how I'm going to use my system to do this. And it's all algorithmic, which is what I'm trying to tell you, is that robots or algorithms do most of the trading. So if robots do most of the trading, let's not forget what the robots actually do. They want to make money. That's their only goal. Okay, now let's round it out because I don't want these videos to be longer than they need to. So let's go to here, our quarterly candle. I'm highlighting a few things here. So we'll first focus on the chart number 1, which is the green arrow. So as I look right here, we'll just read the notes. So over here, going back to 1995 to 1999 and 2000, oh my goodness, look at that rally. It's incredible. This is where if we look a little bit closer or inspect, what does it show us here? Well, it's pretty obvious. Over here, we have a green arrow, which shows we have back-to-back engulfing candles, which means that over a 3-month period or a quarterly candle, twice in a row, we went to a lower low, then a higher high. So we had a bearish engulfing candle. We closed below the low. And then we have a bullish engulfing candle right after. Wow. So full bear, full bull, and then back to rallying. This pattern is so powerful, and I'll show you the reason why. Let's go back to QQQ. Let's go back in time a little bit. There was something called SVB, or Silicon Valley Bank, and there was a little bit of a kerfuffle. What was that? Well, they went bust. People were worried there was going to be contagion. If we look here to a weekly chart for the S&P 500, here's what it shows us. We have back-to-back-to-back engulfing candles. Our candle that sets the range, our first engulfing candle, our second engulfing candle, and then the third engulfing candle. What this literally means is that on a weekly basis, over the course of 4 weeks, at one point, the bears were right once. The bears were right twice. The bears were right 3 times, which means they have pretty high conviction. They're getting evidence they're right. But on the same token, the bulls have evidence they were right once, twice, and 3 times. That's literally the higher high and lower low I'm talking about. My recipe for success. Trading's not all that hard. So if we're bullish or bearish, it literally only matters what the candles tell us. We only form a pattern after 3 bars, though. So hindsight is always 20/20. The reason why I point this out is because look at where we were and look at where we are now. We were at what? 300? Where's QQQ now? Is it higher than 300? Oh, wow. It doubled. Yeah, it did. From here, you can see that once the chart resolved or we found out who won, remember, the bulls were right, the bears were right. There's a little bit of a megaphone. We call that back-to-back engulfing. It went up, a more, and it doubled. Since 2022, that was a very powerful pattern. And over here, people were worried about different things, but they were equally as worried as they are now. Yeah, we're stretched. Yeah, we're too high. Could it go higher? Absolutely. So this back-to-back engulfing candle is very powerful. Remember, this is a quarterly chart, which means that not only during 3 months, but over 6 months, the bears were right, the bulls were right, and only in hindsight did we know who was really right. So back-to-back engulfing candles. Over here, we have a bullish one, and then we have a bearish one, which means we actually roll over after that. Remember, each candle is 3 months. So if each candle is 3 months, what does that tell us about right now? Well, we've already done number 1. Let's inspect a little bit closer. And maybe now you can appreciate the reason why I was worried. I was a worrywart when we had this engulfing candle here, because at one point during the quarter, we were way below the previous low and we slammed down to what I perceive to be support or that previous all-time high. So as of right now, we have a back-to-back one time. So what's going to happen again? Let's look at the second chart, because now this is the part where there's a caveat. There's potentially a bullish narrative here. I'm not trying to tell the chart what it's doing. I just want to make sure I am aware of what history tells me, because we're in extreme fear, but we're at highs. People are worried. They're very worried. Oh, AI bubble. Oh my God, Nvidia, Palantir. There's more stocks than just those two. Broaden your lens and maybe you'll see that. If we look to the second chart here now, there's a caveat on chart number 2. After the first back-to-back, we get 2 candles which actually close over. So engulfing candle number 1, engulfing candle number 2, and then we close above the previous high once, close above the previous high twice. Well, that would get us, so as of right now, if we now look to our current pattern, we actually did print a higher high. We're just not currently above it. So as of right now, we're still tracking this part right here. The candle has to close into the end of the year. So history does not repeat itself, but it often rhymes. Let's continue the story here. After the first back-to-back, we close over that period twice. That's 2 quarters. That's 6 months. That's a long time. If we track, that would take us to the end of the first quarter or the end of March. Then we set up the back-to-back engulfing candles for the second time. Going back to the first chart, that would be right here. So this would get us to back-to-back engulfing number 1, rally above the previous close, rally above the previous high, and then engulfing, peak out, and then crash to where? Basically back to where we are now. Is that so terrible? So if this happens, then we get a blow-off candle. You can see it right there, where we have a close above the previous high, and then we completely wash out. We roll over. This would actually, if we're tracking in, this would take us all the way to the end of 2026. 2026, first quarter of 2027, second quarter of 2027, third quarter of 2027, third quarter of 2027. Basically 2 years from now. Here's where we are. Here's where we could be in 2 years from now. 2 years. Basically where we are right now. And everyone's so worried. Okay. So history does not repeat itself, but it often rhymes. So this is where we're following the pattern so far. But what this also implies is that we're either going to respect this chart and not fall below 610. It's actually 613.23, or we won't. This implies we're going to rally into the end of the year. This chart suggests, oh my God, if we go down to a little bit more, we're going to go down by a lot. So rounding the story out now, this basically tells us that do not take this pattern all on its own. Don't bank on it. Oh, well, Justin said. No, I'm telling you, we could be bearish or bullish. All our job is to do now is to be patient to let these charts resolve themselves one way or the other. We have to rally back above the previous quarterly candle close. Otherwise, it's not bullish. Okay, so these provide a range of outcomes for where we could be on the monthly candle close at Friday at 1 p.m. If we close below the previous low, then this doesn't really matter. It means that we're looking for potentially the decline to stop around 610. And there is a lot of support around 610. It's the annual level. It's that quarterly back test. There's naturally going to be buyers there. It's around the 50 MA. If we look here to the weekly chart, we have 610 as our 50 weekly. We got 615 as our 200 daily. So hiding everything to make the chart really simple, a simple moving average for the 200 DMA or 200-day moving average, 614. The weekly 50 moving average is 610. The monthly 50 average is 495. So convergence or support, convergence or support. And what normally happens when we hit these moving averages? We at least get a bounce. So hit the 200, bounce. Hit the 200, very small bounce. Get close to the 200, bounce. Get to the 200, bounce. So 50 to 200, back to the 200, reclaim the 50. It happens very frequently. We expect to find buyers at least on the initial test, but it did roll over. We did find buyers, but it rolled over anyway. So what this really means is that if we do continue to sell off into Friday, we could sell off a lot more. We would expect to bounce around 610, but it's really going to come down to where we close quarters out, which means end of the year, end of March of next year. That's a very long time. Are you ready to wait and watch your account drip down? Or are you going to manage the risk now? The weekly chart really matters. When in doubt, be patient. I'm going to leave you with one very last thing here because I don't want to make today's video all about fear. I'm giving you a range of outcomes, which means it could be bullish, it could be bearish, but here's what you should do right now if you're feeling your butthole percolate a little bit or you're getting a little bit nervous. The trend is your friend. Understand what the trend is, and you'll be less likely to fall victim to it. So there's bullish, bearish, and kangaroo markets. Pause right now if you need to. This is the second link in the description, which is free as well. There's momentum, which is golden, or momentum, which is death. Okay, that's important. Bitcoin has a death cross right now. Then there's the trend. It's our recipe. It's not all that complicated. And these right here are potentially traps, right? Fail breakdown, fail breakout. So understanding what the chart is likely going to do from here is important. But then what really matters for individual investors trying to beat the market is this one right here. What should I do? Okay, all this information. What do I do though? Do I buy? Do I wait? Do I sell? I've told you over and over, I'm a wussy. And maybe now you can appreciate the reason why. It's because my levels told me to, right? My gut, my levels, everything aligned to say that I am going to regret this a lot more, meaning if we go down. And the really tricky part right now is that you probably have some shoulda, woulda, coulda. Oh my God, if only I would have known stocks were going to crash right here at the exact top, I would have sold everything. It's not about trying to time the market. It's about avoiding what we're going to regret. If the market goes back up to new all-time highs, I won't be surprised. If the market goes all the way down to the bottom, I also won't be surprised because there's only a few best practices. Okay, so what should I do? Should I make a plan? Probably should. I'm expecting fully bully boomtown. I still think the S&P can go to 1,500 on SPY. That's right. I think it can double again. That's what I expect. I'm prepared to be wrong, though. The worst case scenario, it's negative 28 to start. Could be lower. I don't want to be surprised. I want to be less surprised, not unsurprised. So as I get more and more evidence, which is basically what I have here, red is bad, green is good. If I get more bad evidence, I'm not going to ignore it. I'm not going to say this time's totally different. It's totally fine because the AI is real. No, I'm not doing that. I have my plan. It's only 3 steps. So if we're prepared for the worst case scenario, then it's going to be hard for us to be disappointed. But we have to be legitimately prepared for it. So if you're still watching at the 27-minute mark, it means you're receptive to the idea that stocks could crash, and now you're wondering what to do. I just told you. You have to do this on your own because you're the one who hit buy, and you're the one who's going to have the regret. If you don't know where to start, it means you've planned too little, and you probably have too much going on. I'm a stupid, simple guy, so I like to kiss. I like to keep it simple, stupid. That's just me. And then versus now. Did you enter the stock for a different reason than you own it now? What was the initial thesis? As I met that criteria. Okay, so I'm getting some keys for success here, but I still don't know if I should buy, sell, or wait. If you can't decide, again, I can't tell you what to do. I'm not a financial advisor. What I can tell you is what I am doing. And I showed you my account before. What do? When in doubt, I sell half. The reason why for me is because if number 1 happens and we go lower, I'm going to say, phew, thank God I sold half. If we go higher, though, I'm going to say, thank God I only sold half. And because it's exactly 50, my regret is exactly the same. I equally regret if we go higher or lower because it's exactly 50. I'm not like, I should have sold 70%. I should have sold 40. I just do 50. And I keep selling over and over and over. I'll give you one more quick example here because I want to be a little bit more transparent than maybe some other YouTubers are. If you see how many times that I've trimmed here, 1, 2, 3, 4, 5, 6 times. Because every time I look at the chart and I ask myself, what am I going to regret more? If I can't decide, I just sell half. And this stock was a huge position for me when I started. I think it was 7 or 10%. It's down to 1. If we look at the next one here, DDD, I trimmed it 1, 2 times. And I'm going to fire it if it doesn't perform. All right, what's the next one here? TE. I trimmed it 1, 2, 3 times. Okay, what about Tilray? I trimmed it 1, 2, 3 times. Why? Because I'm a scaredy pants. I'm a wussy. So I do this one every time I look at my portfolio and I ask myself, again, based on my levels, from where we are right now, if we slam down to my support and it doesn't hold, what am I going to do? Well, I can move the line back like I did for these stocks going into the weekend. So I'll show you one more really really, really quick example here to try to show you that I'm not full of shit. Let's have a look here. So the reason I want to fire some stocks is because my buy pocket, which means an area to consider buying, green is buy, green is buy. What does it show us here? DDD was at 2. Well, where's DDD now? It's below 2. So what does that mean? It's an area where I should consider buying, area to consider buying. But now I've had to move the number back because it's below there. So I've moved the goalpost back. The stock is working for free, but my tolerance is getting impatient here. The same thing with Tilray. I said sell it at 1.9, and last week I said for Tilray buy it at 1. And I've already moved the goalpost once on it. I have a history here. You can go back and see all the things that I've said before. So Tilray, I said 1.15 before. Then I moved it down to 1. Then I moved it down to 0.85. I should have probably just exited it at 1.9. But here's the part that's really, really, really important. I asked myself this, again, like I told you, what am I going to regret more? There's a reason why I entered the stock. There's a reason why I owned it. There's a reason why I didn't exit it before. It's because of these numbers right here. So when I look back in time, this was back to November 9th. So I said right here that Tilray, let's go with Tilray, 1.15 was the sell. 1.15 was the buy. 1.9 was the sell, which means my risk reward, meaning from where the chart is, at the time it was at 1.24, the risk versus the reward was 7.3 units of reward for every 1 unit of risk. I can make $7.30 for every $1 I'm risking. Well, clearly it didn't go up. It's a YOLO. And as these numbers get updated, I have to ask myself exactly that. Am I risking $1 to make more than $1, or am I not? And right now, my blended risk reward between all of my holdings is 11-1. So I do want some stock in my portfolio, but I want stocks to give me positive feedback. That's why they're highlighted here in yellow. Watch, 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 watch. Why? Because they're about to get fired if they don't perform well. So there you go. I walked you through a couple of real examples on how I manage my account for me to avoid what I'm going to regret more. Being in this business for as long as I have, I'm now 36 years old. I started trading when I was 17. It's more than half my life. I've had a lot of regret over the years. I've made good money. I've lost a lot of money. And everything in between is how I derive those lessons. So if you want to come hang out with me and learn more, or if you want to ask me questions, come hang out at 8:30 a.m. on Monday. Thanks so much.